Alright, today is Wednesday, August 12th, and this is a post market review for today's activities in the stock market. In this video, we will cover the closing analysis, the sector's performance, the futures performance, and we will look at the action of the options market, some of the headlines that shaped the day, and then we will look at the heat map and the performance of individual stocks within the big sectors. And we will answer one of the questions in the title of this video of the tech sector versus the IWM or small and medium caps, the comeback that we have seen in the last few days. Yet today it was muted and we saw technology rallying. Is this going to be a sustainable theme of a yo-yo game again between the small caps that are coming back versus the technology sector? Or was today a one-day wonder for technology and a break and taking a little air off the rally, the hot rally in the comeback stocks? I will answer that question and I will show you how within the heat map. And lastly, of course, we will do the charts analysis. We will cover the SPY and the triple Qs. Gold, we have questions in gold. I will answer the question. If inflation is rising and we saw the data for core prices increasing, why did gold crash? We'll answer that question for you. I will show you in the charts. I will also cover the dollar index chart, Apple's chart, and of course the chart of Tesla. We will answer the question if the stock split is good for Tesla stock or bad. I have an argument here that the stock split will be a negative factor for Tesla stock and will work as a headwind against the bulls and a tailwind for the bears. I will lay out my argument in details and look at the charts of Tesla. And now, of course, looking at the closing of the market, look at the comeback. We talked about the reversal yesterday, saying that you have to wait, hold your gun, because this could be a knee-jerk reaction to whatever news we had at the end of the day. And what do you know? Today we reversed the entire move and we closed in the green across the indices. The Dow Industrial Average closing in the green by 289.93 points or 1.05%. The Nasdaq leading the day with 229.42 points or 2.13%. And the S&P 500 closing in the green by 46.66 points or 1.4%. Not quite at all-times high, but very, very close. And of course, this time around we will cover the Russell because we are comparing the movement in small and medium caps versus the big technology names in the Nasdaq. Here you go, the IWM lagged today, closing in the green, but only by 65 points or 0.65 points, which translates to an increase of 0.4%. And here are the sectors' performance. All sectors closing in the green today. That is exactly what you want to see if you are bullish in the market and you want to see new all-times high. However, you want to see, of course, technology and financials leading, which was not the action today. Financials lagged, yet closing in the green. However, they came last. The gold medal goes to consumer cyclicals, silver goes to tech, and bronze goes to healthcare. What about the futures performance? Are we seeing something new in the futures performance? Not really. The march to the green skies continue in lumber, up 2 to 3% every single day. Crude oil closing in the green today. And of course, we saw a little mini rally in soybean oil, which was of course muted for few days. However, we're seeing a little comeback in wheat and in cattle and of course soybean oil. The laggard were metals, of course. Precious metals, specifically gold and silver, declined but not at the magnitude that they were declining at yesterday. They're trying to find a bottom and a footing to hold on to. Copper faring a little better. Again, the hit in precious metal is not hitting copper because copper is rallying in a technically healthy way versus gold and silver, which had impulsive moves recently. We will discuss that in details in the gold chart discussion. And now let's look at the gamblers market. Anything new in the gamblers market? The options market, the ratios are still favoring calls over puts significantly, but we are seeing more cautious action here, buying a little more puts than last week. And now shifting to the headlines that shaped the day. And of course, the first headline is from Moderna. Moderna scoring another $1.5 billion from the government to buy their vaccine that was not produced yet. I can only wish to scam the government out of 1.5 billion for a product that I don't have yet. And of course, the scam in Moderna and the collusion between the administration and Moderna is way bigger than what happened in the deal with Kodak. If you unpeel the onion with the Moderna deal, you will find a lot of sinister details, and God knows what hidden details that we don't know about the deal yet. Here are some of the questions or some of the details that we know for now. Of course, it all revolves around this mysterious character called Monsif Slawi. Who is Monsif Slawi? He is the vaccine czar of the White House who is overseeing the $10 billion Operation Warp Speed. There are a lot of questions about the transparency of the dealing between the White House, specifically Slawi, and pharmaceutical companies. What we know about this mysterious character, Monsif Slawi, is that he has a very shady and corrupt past. And this is, of course, an article that you can Google and read for yourself to see how shady and disgusting this character is. We know, of course, that he is a board member of Moderna. Can you believe that? The vaccine czar of the White House is a board member of Moderna, and all of a sudden he's allocating these billions of dollars from taxpayers to Moderna. Public Citizen urged that Monsif Slawi to be classified as a government employee, not a free agent, because that's what he's doing right now. How did he get the position? Who knows? But right now he's playing a free agent, being a board member at Moderna, and at the same time being the White House vaccine czar. This is unacceptable, and this is the kind of corruption that you see in third world countries, but we're seeing it here in the United States of America. Of course, we know that Slawi still keeps his stocks and options positions in pharmaceutical companies, specifically over 12 million bucks in Moderna holdings that he was forced to divest after it was uncovered by the media. Yet the rest of his positioning are protected by a court ruling that removed the obligation from Slawi to disclose his holdings in pharmaceutical companies while doing the job as a vaccine czar. And again, here is Public Citizen saying that we are paying twice to Moderna. First, we funded their vaccine research in the tune of over $1 billion. And now the most recent deal of purchasing the vaccine for 1.5 million bucks for 100 million doses, in effect, makes the taxpayer pay twice to Moderna. Once to develop the damn vaccine and then paying again to buy it from Moderna. And we know that we will need more doses and multiple doses per vaccine. So the 1.5 billion will snowball to 3 billion, to 5 billion, to 10 billion. And unless government watchdogs and the SEC put an end to this corruption, it will continue to happen. But make no mistake, we know that Senator Elizabeth Warren raised the flag in the Kodak deal, crashing the stock, and of course the SEC responded by investigating Kodak. Elizabeth Warren has her eyes on Moderna. She raised the questions before, but now as more deals or more shadiness takes place, expect Warren to come back and raise more questions vis-a-vis Moderna. And here is my tweet, of course, from the morning. I explained that Moderna was rallying over 9% pre-market, and we know that Moderna executives, been dumping shares like there is no tomorrow. Every day, every week, every time there is a rally, and today was no different. The moment the market opened, they started dumping stocks, and they crashed the rally from 9%, and Moderna barely closed in the green. Who are the victim from this dumping? Of course, the Robin Hoodiots. The Robin Hoodiots increased their Moderna holdings significantly today, meaning that the executives sold their shares to the Robin Hoodiots, who are now holding the bag. Furthermore, We are seeing that this whole vaccine gold rush bubble burst right in front of our eyes. You saw the action in Anovo crushed or crashed rather, and Sorrento also crashed. So did Novavax. As these quote unquote investors realize that the vaccine wars are heating up and more companies or more countries are developing the vaccine, whatever Novavax or Sorrento comes up with, it'll be just a small little slice in a very big and competitive market. This does not justify the recent run in these stocks and the multi-billion-dollar valuation in these very small stocks with no products and no revenue in many cases. We talked about Filipino President Duarte yesterday volunteering to take the Russian vaccine in public and, of course, making a deal to purchase the Russian vaccine for the Filipino population. And here, of course, we have another country, Saudi Arabia, testing the Chinese vaccine. And if that goes well, they will give the Chinese vaccine to their population. More countries are going to go with the Russian and Chinese vaccine. And we know there is an Indian vaccine going on. We know there's a British vaccine and a German vaccine. So what is the point and the thesis behind the investment and the huge rallies that we've seen in very speculative biopharma companies developing the so-called vaccine? And of course, one of the biggest headlines from yesterday is in the political arena, Joe Biden, of course, chose Kamala Harris to be his VP choice. For those viewers who don't live in the United States, Kamala Harris is a junior senator, meaning that she just started her Senate career. She used to be an attorney general here in California. And of course, the choice was disappointing because it gives Trump the lead. Trump is happy with this choice, and maybe this is why the reason behind the stock rally today. And here is a tweet from Gunlash, the bond king, saying, of course, that he's predicting now Trump will win again due to the choice of Kamala Harris, and he called her too charismatic. Of course, there were allegations of sexism against Gunlash. I don't think that was his intention. I think he was being humorous and sarcastic when he released that statement. Harris, of course, is a senator from California and will not appeal to the core demographic that Biden needs to win this election. What is that demographic? It is white men above the age of 40 in states like Michigan, Wisconsin, Pennsylvania, Florida, North Carolina, Iowa, and the rest of them. Because the Biden coalition and the Democratic coalition already has the majority of the female and the minority vote, they need a little bit of white men to switch from Trump to Biden to win the election. That is now not going to happen with Kamala Harris on the ticket, because now the election becomes Trump versus Kamala. Because we all know that Biden is too old and he could die in office. So of course this is going to be an election between Trump and Kamala that gives Trump the edge. And now, shifting to some economic news, we have comments from Larry Kudlow, the White House economic advisor, saying that the trade deal phase 1 with China doing great. Of course, we know maybe all the cocaine and the Jack Daniels that Larry Kudlow did back in his days taking effect, and now Larry Kudlow is living in a parallel universe where up is down and down is up, and there are V-shaped recoveries and trade deals going great all over the place. Speaking of the V-shaped recovery, here are some news about the decimation of small business in America. While big business like Amazon, Walmart, and Costco thrive, small business is being destroyed. The core and the heart of the American economy and the employment picture in America is being decimated as we speak right now, meaning that the unemployment picture will not improve, and we will see a wave of bankruptcies hitting small business very soon. And of course, is the Fed anywhere to be found here to help small business? Of course not. They're only interested in helping big public companies and pumping the stock market up. Instead of helping small business, the Fed is buying bonds in Apple and blue chip companies that don't need help at all. This is a scam to make big companies eat whatever left of small businesses and become bigger in the process. More economic news and confirmations, of course, of the V-shaped recovery. And I say that sarcastically. The United Kingdom announcing that they are experiencing the biggest recession in their history. They haven't seen this kind of recession back in 2008, 2009, and they haven't seen it even during the World War. This is the biggest recession they've ever registered. And of course, the stock market is living in the la-la land. Here is the proof. The PE ratio, or rather the forward PE ratios, are now exceeding the top and the all-times high during the dot-com bubble. We have become a stock market that is so overvalued now. The mania is way bigger than the dot-com bubble. We know how the dot-com bubble ended, and we know how the mania of this rally will end as well. And of course, some corporate news. Here is Uber turning up the heat in the fight with California. California wants to, of course, make Uber employees into full-time employees, which makes them entitled for benefits, more pay and minimum wages, etc. Of course, this destroys the entire business model of Uber, and Uber is protesting and saying they might shut down in California. Here is a company of the new economy, of course, the gig economy, aka the whole business model is let's burn cash in expense of growth. And someday the company will become profitable. This is at least the thesis. And this decision from California of making Uber drivers into full-time employee pierced the biggest hole in that business model, and Uber will not be able to function at all. So they are threatening to withdraw altogether from California. That of course benefits competitors like Lyft, because the drivers will switch their app to Lyft and they will drive for Lyft instead. This is a suicidal move by Uber. Instead, Uber should spend more money on lobbying and negotiate with the government of California on a compromise. More corporate news. We have confirmation now of the release date of the Microsoft Duo, the new phone from Microsoft that is operated by Android system. I have to be honest to you, it looks very attractive. I'm very interested in it, but I don't know how the specs compared to the other competitors in the market. And of course, the price is at $1,300. It is in the high end of the range for smartphones, and it's really large. It depends on the functionality, if they really differentiate this product from normal phones and tablets, because what is the point of buying this phone if you can buy a tablet separately? But I guess the argument for Microsoft here is instead of buying a phone and a tablet, you can have all in one for $1,300. That could be a very attractive proposition for Microsoft. We will see how this product performs, and of course the reviews will be all over YouTube. And now moving to the heat map. You can see from the heat map right away, this is the battle between tech. Tech is green today, and of course the garbage stocks or the laggard stocks that overperformed the last few days and the last few weeks are taking a break today. So here is the question. Are we going to see a resumption of the march and rally in tech and those small caps to medium caps, the laggards, aka the garbage stocks? But here is something new. We will not call them the garbage stocks anymore. We will call them the comeback stocks. And we will call tech stocks the garbage stocks instead. So what happens in this battle? Is it a one-day wonder for tech, and then we will resume the rally and the march in the comeback stocks? Or did the comeback stocks are now exhausted after a huge rally, and now we're shifting back to technology? To answer this question, you need to look at the map directly. The comeback stocks, yes, they lagged today, but not by much, and some of them actually managed to close in the green. Take a look at AXP, American Express, in the red, but not by much. Disney closing in the green, so did TJ Maxx, so did Mondelez, so did Budweiser, so did Emerson, so did Chevron, and we see, of course, a little bit of losses for Cisco and Live Nation, Ulta, Planet Fitness. Some of the names, of course, if you watch my video from 2 days ago, we picked the comeback names. Their performance today was muted, but some of the names managed to close in the green. What does that tell you? It tells you that we are taking a break. Airlines, cruises, all the comeback stocks rallied significantly the last few weeks and the last few days. They are taking a little bit of a break, allowing more entrants, more investors to rotate from tech and enter into the hot trade of the laggards, aka the comeback stocks. Yet there is a huge slice in the market, and these are a combination of the morons and the Robin Hoodiots and some investors who are not so good in investing, who are waiting for dips in technology still. And when they see a dip in technology like yesterday, they jump in and they buy the per usual names: Apple, Microsoft, Facebook, Tesla, etc. But there is a macro versus a micro theme. The micro theme here is buying the dip in technology. This is a small number of traders. The big institutional macro trend is the rotation from tech to the laggards, aka the comeback stocks. So my expectations, my prediction here is to see a cooling off in these comeback stocks, but they will resume the rally eventually, and you will see tech selling off again. This is what the action in the heat map today tells me where the market's direction will be in the days and weeks to come. And now, shifting to the analysis, the charts analysis of the day, we will start by the SPY, the S&P 500. From a daily perspective, you can see that we have erased the decline and reversal from yesterday, which was a knee-jerk reaction perhaps to the VP announcement or the stimulus announcement. It could have been a lot of things, but it was an algo-triggered sell-off and a reversal. Today, the human beings came and rescued the market and bought it back, pushed it higher than yesterday. However, we did not close at all-time highs yet, which begs the question, when you get closer to all-time highs, it should act like a magnet and the rally should intensify and the SPY should close decisively over all-time high. It's not doing that yet. Keyword yet. What do we see from a weekly perspective in the SPY? We are back in the green again. We talked about this yesterday. We needed to see a reversal back to the green, and you see it happening today. Now, the next step is the SPY closing above all-time high in the green again. That would be a very decisive close from a weekly perspective and a big victory for the bulls. And you can see from our 15 minutes perspective, we pretty much erased all that action from the reversal yesterday, and we're continuing the trend, the slow march to all-time high. What about the Qs? The Qs from a daily perspective, the trend line is still intact, and I told you, until the trend line is broken and until we see a reversal in the MACD from a weekly perspective, the Qs are still intact. Yes, there is a rotation, but until the rotation intensifies and becomes stronger, or more institutions start rotating from tech to small to medium caps, right now the chart of the triple Qs is still healthy, still bullish from a daily perspective. Switching to the weekly perspective, you can see that we need to close above last week's closing. We're still not there yet. If we reverse, we still have 2 days. If we reverse, closing lower and in the red and lower than last week's candle, that would be very bearish and a signal for a reversal in the Qs. Closing above last week's candle would be a signal that the Qs are not ready to reverse yet, and perhaps there's a little more steam for the Qs to gather before the big rotation takes place. And from a 15 minutes perspective, you can see the Qs were bought in the morning and it was a steady, continuous march, no stop inside except a little break before the market closing, and that was of course bought as well. And now shifting to an important chart, gold. The question, of course, and you can see from this tweet from whatever her name is, saying that inflation data and core prices came higher than expected. When we say expected, that's what the analysts are expecting, not the market, not the movement in gold. This is the important question. So when you ask why did gold crash while inflation came higher than expected, it does not make sense. It actually does make sense from a technical perspective and a psychological perspective. Meaning, you get into the battle of expectations versus reality. Looking at the daily chart of gold, we were very extended. The expectations here for movement like this was for a really big, huge number in inflation that not just exceeded the analysts' expectations, but it also exceeded the market's expectations that are already priced in the gold's chart movement. That did not happen. Inflation came high, but not as high as what gold was expecting from this chart. from this rally and move. And therefore, you see the technicals and the psychology taking place, and the early entrance of gold selling their holdings, taking profits, booking profits because they're saying, yeah, inflation is higher, but it's not justify where we at right now. Now, from a daily chart, you can see that we're making the spin indecisive, trying to find a footing kind of look. There's a flip side to the psychological coin. There are people who watch the rally in gold and they have the fear of missing out. They didn't get in. They've been watching gold rally, but it was too expensive and they couldn't get in the rally. They were waiting for a pullback. These people are now going to see an opportunity to hop into gold and rally gold back to challenge the highs. You have to keep that in mind. Even if yields rally, even if the dollar rallies again, and even if core inflation prices come lower again, the psychology alone of people waiting in the sidelines to enter the gold trade. They've been waiting and waiting and waiting. Now it's the time for them to enter the trade. For me personally, I think you should wait a little more before you enter. But regardless, some of these traders will enter the gold trade and will push it higher again. So we're seeing these disparities from fundamentals versus technicals and psychological factors. And we saw that, of course, in the yields as well. If the auctions for bonds and treasury notes came better than expected, shouldn't the prices go up and yields go down? But we saw the opposite thing happen yesterday because the technicals and the psychological factors are taking over fundamentals. This is very important for you to understand. And you can see, of course, from the weekly chart of gold that now it's becoming a healthier chart. It is not diverging significantly from the 20 weeks moving average. It is finding a footing. It needs to wait a little bit, let the average catch up with the movement, and then resume the rally again. And here is, of course, a chart of the dollar index. The dollar index is a different story because it is trading lower and it has a very bearish look. However, the bull argument here is look at the saucer movement that we're making in the chart. We have not slipped below it. The dollar index is finding its footing and it will rally and reverse the negative course that it's been on for the last few weeks. That is the bull argument. The bear argument from a technical perspective is, no, this is not a footing. This is a bear flag, a primary move, a consolidation, and then we see the resumption of the negative move. I tend to be on the bear side when it comes to the dollar index because the fundamental factors outside of technicals support more weakness in the dollar index. And now, switching to Apple's chart, you can see that Apple, of course, recovered completely from a daily perspective. It's looking healthy from a daily perspective, and you see that $2 trillion valuation at around $477 becoming a goal and a psychological milestone to achieve. It acts as a magnet, just like the all-time high act like a magnet in the SPY chart. The $2 trillion valuation act as a magnet for Apple's stock. Yet when you look at the weekly chart, you can see that this chart is very, very unhealthy. The extension from the 20 weeks moving average is becoming very severe. You've seen what happened to gold. This is exactly what will happen to Apple. And you see, of course, my line in the sand for the RSI, the top that I'm anticipating. We're getting very close to it from a weekly perspective, so I'm keeping my eyes close for the movement to come that line and then short the stock again. And of course, from 15 minutes perspective, I released a tweet identifying the channel that Apple been trading in. That is the bear channel, the negative channel. Closing above the channel is very bullish. And what do you know? Apple closed above the channel. That is a very bullish behavior. So short-term bullish on Apple, long-term bearish. And now moving to the biggest chart of the day, Tesla. Of course, upon the announcement of the stock split 5-1, we've seen what happened to Apple. A lot of traders don't understand what a stock split is, specifically the Robin Hoodiots crowd. And today they stampede on Tesla shares, just like they did with Apple, buying at any prices, at any level. It doesn't matter. Just buy. Ask questions later. Matter of fact, don't ask questions. Just buy because stock splits are good for the stock. This is their argument, but of course, they don't understand what a stock split is. Here is a humorous tweet, of course, explaining the logic between the logic of the Robin Hoodiots. Of course, they think stock splits are positive for the stock and for your holdings and it makes you richer. And of course, this argument is very stupid because it's like cutting a dollar bill in half and saying now I'm twice richer than I used to before. No, you're not. You still have the same $1 bill. Matter of fact, you just cut it in half and now it might not function and it might not count. So you're not richer. You still have $1 in effect. This is exactly what happens in stock splits. Your position will remain the same. If you buy now, you will not get 4 more for free after the split. Your holdings remains the same. And of course, the argument that lowering the price will encourage more retail investors to buy Tesla stock is a phony, stupid argument because we do have fractional shares, and you've seen the Robinhood crowd stampeding on Tesla shares even though they're priced at over $1,400 a share. So there is no problem for retail investors buying the stock. Lowering the price of the stock will not make it attractive for new entrants to come and buy the stock. In fact, it will do the opposite effect. It will make it attractive for shorts to short Tesla again. Meaning, I had a short position in Tesla. I announced it on Twitter. I shorted at 1750 and I closed my short a few days ago. I swear I did not know that the stock would split. If I'd known, I would have told you. But the timing was perfect here, of course. Now, to short shares of Tesla, I shorted 100 shares, meaning that I borrowed over $175,000 from my lender. That comes with a lot of fees and a lot of risk because you're borrowing a massive amount to short 100 shares. Now, what happens if the stock price goes down to 300 again and you want to short 100 shares? It's a lot cheaper. The fees alone eat up at your profits if you're shorting a stock over $1,000. When I borrow $175,000 from my lender, I am paying fees on that and it's very expensive. However, when the stock price comes down to 300, it will be less expensive to short and put options will be less expensive. Meaning if you are betting on a movement in Tesla of a decline of 5%, it will cost you a lot less to do that trade. On the other hand, if you're a Tesla bull and you're anticipating a movement of say 3% on the green for Tesla, your position will remain the same. Whether the stock is trading at $1,500 a share or $300 a share, a movement of 2 to 3% will have the same effect in your holding. No difference whatsoever after the stock split and before the stock split. You will still gain 3%. The only thing that the stock split achieves is it makes it attractive and cheaper for shorts to attack the stock again. I don't know how this becomes a positive factor for Tesla. We know that the short float in Tesla decreased from 30% to about 9%, and one of the reasons for the shorts to scramble and cover their shorts was that Tesla stock is becoming too expensive and the losses becoming more severe. So you have to cover your shorts, and the high price itself discouraged a lot of shorts, at least amateur shorts, from shorting the stock because it is too expensive and risky to do so. Now when you lower the price, you make it easier for those shorts to come back and short the stock again. This is not good for Tesla, and I think the traders who bought the stock today haven't thought the entire process through. Now looking at the daily chart, you can see a reversal in Tesla, reversing a few days of declines and muted action. That is positive from a daily perspective, but when you look from a weekly perspective, we are still in a bear flag negative formation. We have seen that bear flag happen before the correction in Tesla, even though it got really close into challenging the top end of the flag before it reversed. So we could see another scenario here of Tesla rallying for a few days. That does not change the negative and the bear flag formation from a weekly perspective. So be careful here and think it through. Is it better to buy the stock now or after the split when it's cheaper? Because it doesn't really make any difference. You can buy fractional shares now, and if you buy one share of Tesla today at $1,500, it's going to be the same thing as buying the stock when it splits 5 to 1. one share will cost you exactly, or excuse me, one share will become 5 shares and will cost you exactly the same. And of course, we have a history from stock splits. The stock split mania disappeared after the 80s and 90s. We saw some major stock splits here and there in the 2000s and the 2010s, but we know from history that stock splits manias mark a top for these stocks. Meaning, you see the rush and the mania to reserve your seat. These traders, of course, the Robinhoodians and the rest of them, reserving their seats in the shares before the split, thinking that this is somehow a good thing. Whether they think that they will get 4 more shares for each stock they buy, or whatever reason they have. You see a surge in these shares trading higher and higher before the actual split happens. As we approach the split and after the split, you see the sell the news phenomena taking place, where the stock sells off and it never gets back to those prior levels for a long, long time. So be careful and study the history of stock splits. All right, to conclude the video here, we have seen a comeback for tech. Is it a one-day wonder or not? I think it could last a few days to take a little air of the hot rally from small and medium caps. But overall, all in all, we will see a resumption of that trade, the small caps, the IWM taking place again, and we will see a sell-off in technology. So the rotation is real. The rotation will continue to happen, but we need to take a little pause and a little break for now. If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.